Unveiling the secondment model, navigating broader tax implications. In the rapidly globalizing business world, the practice of secondment, where employees are temporarily transferred to work for another business organization or a different part of their current employer, has become increasingly common. Secondment agreements are typically established between three parties: the secondee, the original employer, and the host employer. While this provides flexibility and growth opportunities, enhanced collaboration, etc., it also raises intricate tax questions. Who is the actual employer? What are the tax liabilities for the secondees and the organizations involved? The answer hinges on the specifics of the secondment arrangement and the relevant tax laws. Here's a broader look at the tax implication of the secondment model. Tax implication for the employee. Income tax. Employer may be subject to double taxation if the host and home country do not have a tax treaty. Social security. Depending on the agreement between countries, employees might need to contribute to social security system in both home and host country. Due consideration should be given to the social security agreements. Tax residency. The length and nature of secondment can affect the employer's tax residency status, altering where and how they are taxed. Tax implications for the employer. Corporate tax. The presence of secondee might create a permanent establishment in the host country, subjecting the employer to corporate taxes there. Withholding taxes. Employers need to understand the withholding tax requirement in the host country and ensure compliance. Transfer pricing implications in secondment. The secondee services is essentially a service provided by one entity to another. The price charged for the service must reflect arm's length price as if the entities were independent. Companies should maintain robust documentation demonstrating how the pricing was determined and that it adheres to the arm's length principle. Further, if the secondee's activity create a permanent establishment in the host country, it can also lead to transfer pricing implications. Indirect taxes. The provision of services or goods in the context of secondment might trigger VAT or other indirect taxes. Other consideration: conducting a thorough risk assessment. Prior to embarking on a secondment arrangement, companies should conduct a comprehensive risk assessment. This involves evaluating the potential tax implication, considering the local country laws and the tax treaty, legal consideration, and other relevant factors. Identifying and addressing risk at the outset can save both time and resources in the long run. Documentation. Maintaining detailed record and contracts is crucial for proving the nature and terms of the secondment. Clear documentation can help mitigate potential risk by delineating the roles and responsibilities. Conclusion. Navigating the tax implication of the secondment model requires a thorough understanding of both domestic and international tax laws, as well as careful planning and compliance efforts for all the parties involved. Companies engaging in or considering secondment arrangements must stay abreast of the development and ensure their agreements are well documented and in compliance with the evolving tax landscape. Thank you all for watching.